Most important signals on any stock chart, as basic as this is volume. In fact, I bet you heard the old saying, volume equals validity. And that's certainly true. So if the prices are going higher, the market's telling you that prices want to go higher. If it's happening on heavy volume, then that signal is a valid signal. That message is a valid message. It's not a lie. There are some times where the market will go higher, but it's on light volume, and the message is not valid. They're trying to make you think the market wants to go higher. If you want to understand why volume is so important to successful chart analysis, listen up and I'll show you what to look out for. There are two main reasons to track volume. One is by using volume analysis, you can anticipate changes in the stock's price. Big volume tends to precede major price movements, whether up or down. And again, when I say volume, I mean the number of shares that are traded in any given day. So if you're looking at Google stock, how many shares have traded? How many buy or sell orders were there? That's volume. And big volume tends to precede major price movements, whether up or down. So you can see clues as to an upcoming big movement. And that makes it a lot easier to find the stock markets or an individual stock's next move. And number two, we use volume trends to confirm what a stock's price is telling us, which I mentioned a little bit before. If a stock's trend is accompanied by consistently increasing volume, that trend is likely to continue. You might even see a stock move higher on very big volume and even higher on big volume, but not quite as big. Well, that stock might continue a little bit higher, but then is likely to reverse down pretty soon. The greater the volume is behind a stock's move, the bigger the force is behind that move. So think about it. Don't you want to own a stock where you have great big institutional fund managers that are out there buying it? You want the wind at your sails. You want to own stocks that have institutional sponsorship. But if that trend that you see to the upside is not accompanied by increasing volume, it's weak and it's likely to end soon. And that's where we come back to that old saying, volume equals validity. Again, we consider a move in a stock or even an index or an ETF to be a valid move when there's heavy volume or force behind it. So when you see a really big increase in volume on any stock's chart, usually it indicates huge institutional investors are there and they're buying or selling. And hey, the institutional funds control about 80% of the stock market. That's some serious firepower. When even one of those funds likes a stock, they're likely to take positions amounting to $50 million, $100 million, $500 million, billions of dollars. Just consider the Occidental Petroleum stock, OXY, that Warren Buffett's Berkshire Hathaway recently bought. Now, this is a stock that I've traded and recommended many times myself. As of late March, his stake in OXY was worth $8 billion. Here's an example of what just a fraction of that huge position looked like on the OXY chart. Look at that huge spike in volume from early March to late March. That's when Berkshire bought about 100 million shares of OXY. As an individual investor, you want to understand where those big funds are buying or selling. Why? Well, that's where the smart money is. Think about it. Why do I say smart money? The funds are professionally managed. They're backed by multi-million-dollar research budgets and major experience. So you don't want to go up against somebody who's paying millions of dollars to be right. Just look at what they're doing and follow what they're doing. You could save millions of dollars in research yourself. Plus, there's usually more than just one fund buying or selling large positions in a particular stock. If one fund sees something, it's probably something that's visible to other funds. Especially in large cap stocks, there could be 50, 100, or even more funds that are trying to take the same position. In large cap stocks, sometimes it's thousands of funds in the same stock at the same time. So, maybe needless to say, but I'm going to say it anyway. When those huge funds take large positions, bullish or bearish, betting up or down, it's pretty tough to do without the whole world knowing. They leave large footprints. Yes, there are ways that they could do it without the world seeing, but you see it on any given chart. You'll see it. They have to buy or short sell enormous amounts of stock for any given position just to make a dent in their fund's performance. Think about it. If they have a fund that manages so much money, they have to buy a lot of one stock just for it to be meaningful. Imagine if they buy something and they can only invest 0.1% of their fund into it. Even if that stock doubles, it's not really going to do much. So they have to invest a lot of money into a stock in order for it to be worth it. And all that buying power or selling pressure results in huge movements up or down, even in the large or mega cap stocks. So let's take a step back here for a second and take a look at the volume indicator. Now, on any stock's price chart, usually by default, it's really common to see a volume graph, just like this at the bottom of each chart. Now, each of those bars that you see shooting in an upwards direction indicate 1 day of trading activity. And that's because we're looking at a daily chart. If you were looking at a weekly chart, each bar would represent 1 week of activity, and so on. But the huge green bars that you see on your screen indicate that buyers were in control on any given day's trading when the bar is green. And the red bars indicate where sellers were in control. So basically, when the bar is green, it was an up day. When the bar is red, it was a down day. So when you see those big spikes in volume and the bar is green, it's basically telling you that there's a big spike in volume and the stock or the market was up. Okay, again, volume equals validity. So big volume, up day, means the signal is valid that this stock wants to go higher. But what matters the most is the height of the bars, or basically how much volume the stock is traded. So the large highlighted bars towards the right side of this histogram show where a battle was waged and at a certain price point. So let's take a look at the price chart that goes with that histogram. Here you can see the clear level of resistance shown as a horizontal line. It's a resistance level. It's where buyers were trying to buy so much stock that they could push the stock above that price, but they were unable to because at that price, sellers came in and sold so much stock that it was overwhelming the buyers, and they stopped buying and they let the stock pull back a little bit. In fact, the price action here, you could see this clear level of resistance on the horizontal line. As I said, it's sitting around 950, okay, on this stock. Now, the price action is sending a very important message. See the big spiking green candlestick labeled breakout? It's a very big deal that the share price broke out above that resistance level. Remember we said they weren't able to do it before. They didn't have enough firepower before, right? But the question remains, can you trust what the price is telling you? Remember, if the price is going up, it's telling you the stock wants to go up more. If it's going down, it's telling you it wants to go down by more. But can you trust that message? And just how confident can you feel about that move higher or lower? Again, that's where volume comes in. So we move on to volume price analysis. Now, volume tells you whether a stock price is valid or not. I've said that repeatedly. Why? Because you want to know whether you should believe it or not. Remember this, if a stock's price is accompanied by sizable volume in an upside rally, then the answer is yes, you should listen to what the price is telling you. And that also be true if there's sizable volume to the downside. That's why certain price levels become support or resistance. Again, remember those huge institutional funds that I mentioned just a few minutes ago, that heavy volume is telling us that this is a price where we can count on the institutions wanting to come in and either buy or sell the stock. If it's where they historically came in and sold the stock, then that level would form a resistance level, like a ceiling. But if it's where they historically came in and bought, then that level would form a support level. And by the way, if a stock's price is moving up on heavy volume, it doesn't mean it's going to continue that uptrend right then and there. And I think that's one of the most important parts of this video that you need to really focus on here. This is where I know I've spoken to thousands and thousands of individual investors throughout my career, and this is one part where they get tripped up. So remember this. Again, if a stock's price is moving up on heavy volume, the stock is telling you it wants to go higher. And the message is valid, heavy volume. But that stock still might pull back a little bit before the next move higher. So that's why when you're looking for a stock to buy, you want to find one that's in a major upward direction. The major uptrend is a long-term trend, but it's pulled back within that uptrend. And when you're looking at what happened over the previous several months or even several years, you want to see big volume spikes when it pushes the stock higher and light volume on the way down. Now let's go back to that stock chart that we looked at. It's actually Frontline, FRO. You can clearly see the pullback on that stock. In this study, FRO saw its price breakout above 950 on March 7, 2022, but look closely and you can see that it did not go up in a straight line. Instead, it pulled back. Notice that that pullback was to a higher low. So yes, it made a low, but it was a higher low than the previous low. And that was to the same levels where the big volume had previously been. So again, it pulled back, it made a higher low, and that's where big volume had previously been. In other words, the volume is telling you the price where those big investors agree that the stock should be trading. So anytime you want to know where a stock should be trading, where the market believes it should be trading, look at where the big volume was at the time. Again, if you see big volume push a stock above a line of resistance, it doesn't mean the stock's going to go up in a straight line. But what it does mean is there was a battle fought there where resistance usually is, that ceiling usually is, and this time the buyers bought so much stock that they overwhelmed the sellers and scared them away. Here's another side note. Don't just look at the chart and think, green arrow buy, red arrow sell, and here's the signal that tells you what to do. Think about what's really happening. I have this benefit because I worked on Wall Street for 10 years. I worked in major boardrooms where you see hundreds of brokers all calling their clients and getting them into the same trade. And they take those tickets. Back in when I was there, they would actually walk the tickets over to the desk. The trade desk would be the one that actually makes the trade for the firm. It's not a bunch of stockbrokers that are just clicking like you do on your Ameritrade account. They're actually running to their trade desk, and the trade desk is actually executing the trade. Now, if we were a big buyer as a brokerage firm of XYZ stock, we don't want the whole world to know about it. It's confidential. I know it's very tough to keep something confidential when there's 100 people in the room, but we try to keep it confidential. And the trade desk doesn't show its hand to the rest of the world. So there's a bunch of other traders, a bunch of other trade desks at a bunch of other brokerage firms, and they're all looking at the same screen. And nobody knows exactly how much stock there is to buy. Nobody knows how much each brokerage firm has to purchase. So my brokerage firm might have 10 million shares that we're trying to buy because a bunch of brokers came in with buy tickets and gave it to the trader, and it all adds up to 10 million shares. Or maybe Goldman Sachs is out there buying stock for their own account, and they're buying 10 or 20 or 100 million shares, whatever it is. It sounds like a large number, but point is, you've got groups of people that are all buying the same stock, but they're not showing their hands. They're not showing how much they have to buy. And here's the reason. If you're trying to sell the stock, you're some other brokerage firm, trade desk, and you've got 3 million shares to sell, you don't want that buyer to know that you only have 3 million shares to sell, because that buyer knows that they have more stock to buy than you have to sell. They've got 10 million to buy, you've got 3 million to sell. If they know that, they are going to run right over you, right? And keep in mind, if you've been selling that stock short, in other words, betting against the stock, you're betting on it trading lower, you're actually going to lose money if that stock can manage to break that resistance level. If the stock breaks the resistance level, it's going up, the short sellers, those bears, are losing money. And to exit that position, they have to buy back all of the stock that they have sold short. Now they're buying along with their counterpart. So there's a double whammy of buying pressure, and it causes a short squeeze. If you're the seller of a stock, you're selling it short, you're building up your short sale position. You're hoping it goes lower so you can make a lot of money on that giant position. But if it goes the other way, you're screwed. You might lose your job. You're certainly going to lose out on some money. And life is just not as easy. So as the seller, you're not showing the buyers how much stock you have to sell. You want to make the buyers think that you have 100 million shares to sell. So they're behaving with their trading in a way that they're hoping, spooks the other trader and they don't call your bluff. Now, what if that trader does call your bluff? There's a couple of reasons why a stock will break above a resistance level. Number one is because the seller said, you know what? I'm not going to sit here and sell all this stock. I think they have 10 million shares, which means they're going to buy the stock, which means they're going to push the stock higher. And I'm a seller of this stock, and I would like to sell it at a higher price. So let me just get out of the way, step to the side, and let these buyers push the stock higher. Think about tug of war when you have two groups holding onto a rope and trying to pull it back. Well, one group could pull the rope so hard that this group falls and they win, or that group could just let the rope go and then the other group wins, but they fell on their backs. Well, when a stock is trying to break through a resistance level and the sellers merely step out of the way, they want the stock to go higher so that they can then come in and just pound that stock down with lots of selling, but at a better price. All right? So if a stock breaks above a resistance level and it's on light volume, not a lot of volume, those volume bars are small, you can probably bet that the situation I just described is what's happening, where sellers have stock to sell, but they're just going to get out of the way and let it run a little bit higher before they do so. The other scenario, I said there's two, is that there are sellers there, they've got 3 million shares of stock, and these buyers have 10 million shares of stock to buy, and for every time the short sellers sell, the buyer's right there to buy it. Continue buying, continue buying. And those short sellers saying, you know what? We're going to scare the heck out of these buyers. Let's dump 100,000 shares, another 100, give me 500,000 shares, dump it on those buyers. And those buyers are saying, come on, I'll take it, give me. And then the seller sells all 3 million shares. Again, they're initiating a short sale position. They've been authorized to sell 3 million shares. Remember, it costs money to sell it to short the stock. And so they have a limited budget on how much stock they can short. But these buyers said, come on. And what happened? They have no more stock to sell. They bought all 3 million shares. These guys still have 7 million shares to buy. And then they're running the price higher, and those short sellers have to cover. And all that stock that they bought, they're profitable on. So that's why volume equals validity. So when that stock eventually pulls back, it's going to pull back to that level of support where there was big volume before. Because those big buyers with the 10 million shares that bought the 3 million shares, they bought a lot of stock at that price. And a lot of new buyers came in and bought at that price. And the whole world knows that that resistance level was just broken, so they know what just happened. So they go in and buy at that price. So the fact that there's so much buying, so much volume, tells you that a lot of people got in at that price. And when a lot of big institutional money managers got in at that price, they're going to do what's called support that stock, supporting that stock. They're going to support the stock at that price. So if the stock pulls back, that old resistance level becomes the new support level, because you've got all those people that don't want the stock to break below that price, because if they do, now they're running at a loss. And each of those fund managers has different rules of how much of loss they're allowed to take before they have to exit the position and cut their loss. So if it goes down 3%, one group of investors has to get out. If it goes down 5%, more investors has to get out. So investors who own a big position in a stock might support the price of that stock. I've done it. I've done it many times with my brokerage firm. Think about a team of 100 people in a boardroom, and the stock has come down from 20 down to 10. And I know that if the stock goes down to 10, it's likely to continue down to 5. Or put it this way, if you got a stock that's at 10 and it's going down to 5, I know that if it goes below 5, investors aren't allowed to buy that stock on margin. And any investor that has that stock on margin now has to sell that stock or some other stock to maintain their position. So below 5 is a killer. So the stock that we owned millions and millions of shares of might come down from 10 down to 5, and everybody in the firm gets together and stands there like a wall and just buys and buys and buys and buys. No matter what is for sale, we're going to buy it. If we have to buy the whole damn company, we're going to buy it. Again, what happens is people are shorting the stock on the other side saying, I know if it goes below 5, that stock's probably going to have a hard time staying up. So they're trying to nail it at the same time, and we're just standing there saying, come on. So volume is more important on a breakout to the upside than it is on a breakdown. So when a stock is breaking above resistance, big achievement. But when a stock's price is moving lower and it breaks down through a support level, increased volume is also important, but just not as important as the upside. So it's a little caveat that not a lot of people know. It's also really important to understand that volume does more than just validate a breakout above a resistance level or below a support level. It's a tool for confirming or validating every kind of chart pattern there is, including candlestick patterns or chart formations like the head and shoulders top formation or triangles. A candlestick pattern can tell you a lot of things. Think about a doji. If you have a doji with lots of volume, it's that much more potent. It's actually critical. Here's a couple of the most important points you want to remember before I let you go. And by the way, if you like what I'm saying here, just pause this for a second. Before you forget, click subscribe. I want to give you more of this. Now, if the chart puts in a doji candlestick, which is typically a reversal pattern, it's known as the single most potent reversal pattern in candlestick charting, you want to look for the volume to support that reversal. And if you see a head and shoulders, a triangle, or any of the other chart patterns again, it's the volume that validates the pattern, okay? So once you start learning about patterns, if you haven't started yet, just remember volume is key. Far too many technical patterns to cover in this video today, so I'm not gonna do it. But here's the point. Just like another old saying, where there's smoke, there's fire. If there's volume, then the message you've seen is a real message. And if the volume isn't there, institutional investors are just trying to trick other brokerage firms, computers, and yes, even retail traders like you. All right, that's it for today. Again, subscribe, comment. I might even leave an answer if you leave me a comment. Share this, like it, whatever you got to do. But I will be back with more videos on candlestick charting. And again, thank you very much for your time.